It is an absolute pleasure to bring on really one of the most respected guys I know on all of Wall Street, Peter Kenny. Thanks so much for joining us, Peter.
Thank you for your kind words, Jordan. I'm thrilled to be here.
There's a lot of unusual activity, and who else to bring in but a 20-year member of the New York Stock Exchange. 7 years you were over at Knight Capital as the global market strategist. And I think right now there's a lot of discussion about how important boards are to companies. I know you're the lead independent director over the Bank of Ozark. So with all these countercurrents going on, the only way we get to hear from you, frankly, that I know of is Kenny's commentary, which you've been really kind enough to allow me to jump in with you. And every week it comes out. For years I've read it. There's not a lot of contributors. It's you and Sam Stovall jumps in a lot, and that's a pretty good company. So I want to thank you and tell all the listeners, try to subscribe to it. It comes out Monday morning and gives you real good insight on what's happened, what's happening, and what to expect. So let's jump into the markets right now, Peter, because we've been in the business a long time. When I got in the business, treasuries yielded 8%, 10%, munis yielded 8%. We're in this environment of lower for longer, these sub 1%, tough ways. How do you generate? I think a lot of what you do at Bank of Ozark has helped them to, on the fixed income side, I believe.
The focus at Bank OZK is fixed income. What I do professionally is separate from that. I'm the lead independent director at Bank OZK, but away from that, in my line of business, which is my 9 to 5, so to speak, I do a lot of strategizing like you. I do a lot of writing, a lot of commentary work, and a lot of consulting. In this environment where it's lower, longer, you have to have an approach that takes advantage of the inefficiencies in the market, and you have to be extremely methodical about it. When I got into the market in 1982, the Dow was trading at 727. I've seen my fair share of things and have managed to live through them, thank God. But it's been tough, and right now I've never seen anything like what we're seeing now. These low rates are forcing investors to do irrational things in some respect. In that you see a lot of the growth stories really dominating the headlines. It makes me a little uncomfortable, to be honest with you. And yet there's sound reason for some of it. We are not only in lower rates for longer, we're in an environment that is dominated by a pandemic, which is rewarding technology companies, particularly software companies, that can take advantage of how that new workforce materializes over time. So you're seeing some really dynamic growth in some of the companies that deliver on that deliver on the green revolution, that deliver on electricity distribution, charging, things of that nature. So if you're in one or two of those verticals, you're doing fabulously well. And if you're in the broader market in terms of indices, you're not doing all that bad. But you do have to wonder, at what point do these real high flyers and the market as a whole pull back 5-10%. Law of averages would suggest that needs to happen certainly in the next quarter, the next 3 months.
Right. Well, I think a lot of people would be happy if the pullback in the high flyers was only 5 or 10%. We've lived through a lot more than that. And, at Lebenthal, it's a very conservative firm. It's known for generating income. I am on the equity side. I have a model that really talks about, facts, the thing that when we first met, the most trustworthy companies. But I'm also involved in something right now, the dividend growth strategy, where we're using the magnet model not to look for the highest dividends, but the best balance sheets with the best history of dividend growth. And what do you think about that kind of strategy?
I love that strategy. Your strategies are really rooted in the long-term truths of the market. They're rooted in where value is over a long period of time. And over a long period of time, those are precisely the companies, the management, the discipline that you want, because those companies are going to outperform in the long term, and they're also going to outperform in the middle term, in that even if there's choppiness in the market, those companies will be rewarded for their discipline, because long-term investors and short-term investors both are always looking for companies that can manage their balance sheets well, companies that have a lot of liquidity, solid balance sheet, strong corporate culture, leadership from top to bottom and bottom to top. Those things matter, and they really matter when things get dicey and choppy in the market. We've seen that.
Right. I couldn't agree anymore. It sounds like you were reading out of my playbook, Peter. And so what's difficult, I think, right now is people are watching the market. They're watching certain companies move so quickly. And so I really want to ask you, as a member of the exchange, and seeing some of these, the most dramatic short squeezes I've ever seen in my life. There's something going on under the current, and maybe the market acts a little different. Margin maybe that's going on. I mean, this is unusual. Can you jump in on how abnormal some trading activity has been lately?
Well, in order to understand some of this unusual behavior in terms of price action, you have to go back a few years and understand how things were unbundled in terms of regulation on the exchanges. When I was on the street, when I was on the floor of the New York Stock Exchange as a very young member, I was a member in 1987. I had just become a member before the crash. You used to have to be able to sell on a plus tick or a zero plus tick. And you know what I'm talking about.
Yes.
Now, to the average layperson, what does that mean? Why does it matter? Well, now that you don't have to short on a plus tick or a zero plus tick, you can sell on a straight minus tick or a zero minus tick, or let's just keep it to a zero minus tick. Mm-hmm. What's that doing is driving volatility into the market. And I don't think that investors have been provided best advice on that. I think that that's driven volatility, and it's driven a tremendous amount of whipsaw action in the market. You see these squeezes that we're seeing just recently in the market. I mean, these things it is really something to look at. And of course, that's the opposite side of that deregulation. You would not see short squeezes like we're seeing if you still had that zero plus tick rule in the market. It's the counterbalance to that shift in regulation, which shed that, regulation in terms of short selling.
Peter, not a lot of people have had that, behind the scenes that you've had. And frankly, you grew up in the business as a kid. And I really have to just mention, your dad was one of the most respected guys on the street. And you followed in his footsteps, Peter. He'd be very, very proud to see what you've accomplished. But you're seeing things, you could talk about things that most people don't really understand. Some people have been talking to me about, there was an article, in fact, in the New York Times today about option trading leading the issuers of the options to go buy the stock, and leads to a cascading issue. And can you talk about that for a minute at all? Are you familiar with that?
I am familiar with that. And that's an inefficiency that must be looked at. The market is constantly changing, and the inefficiencies that are born out of creative thinking and people looking for yield, return on their investment. This is a classic example of where, and I'm not a big regulator guy, okay, but this is a classic example where I think regulators need to just take a look at who's being disenfranchised by this process and who is actually who's able to monetize this process. The general public isn't able to monetize this public to the extent that the insiders are. And that inequity, I think, really is crying out for at least some examination.
Yeah, I mean, I think it needs a lot of examination. And I think that the struggle and the key that I'm trying to remind everybody is not to get distracted by some aberrant behavior of a couple issues. People saying the market is either rigged or it's crazy, or it's a bubble. I think if you systematically and discipline look through the balance sheets and create a disciplined, diversified portfolio, you could tune out a lot of the noise, and the noise is what gets you. I made a comment in your commentary this week about Mr. Market, and remembering he does get grumpy. He does give you opportunities. And so, Peter, I will share that both Dominic and Michael, who are running Lebenthal, are also veterans. They knew you were coming on. They wanted to step in and ask you questions. So if we can get the engineers to bring Mike and Dom on, if they've got something to ask you. And I just really want to say that the market is founded on dividends, growth, balance sheets, real things, not just charts. And I think too many people, when I try to show them the market, I had interns, they would gravitate to the charts and they didn't want to do the hard work. But there's Dom and there's Mike, and let's see what they'd like to jump in on. So, Peter, thanks for the time. I love you having you on.
Thanks for having me.
Hey, Peter, we're running low on time, so I just want to jump in quick, if I may. So, and as Jordan said, we're both, myself and Mike, have been in the industry for a very long time, dating back to the early 80s. But this last decade we went through, and I'm still scarred by March of 2009, we've seen exceptional returns in the major indices. And my sneaking suspicion the next decade is not going to be quite as good as the last decade. Maybe you want to touch on that a little bit?
I think that's a great call. I would refer to that as the reversion to the mean. And I've written about that in my note. I think you're right. I think we're going to see some of those extraordinary returns come back down to earth. I'm a long-term bull. I'm a huge advocate for very disciplined investing. And to me, you may see some bull markets within the market. You may see some verticals within the market outperform the broader market and give those really rewarding returns. But generally speaking, the broader market there has to be a reversion to the mean. Hopefully it's orderly.
Peter, real quick, and thank you for being on the show. You mentioned in the beginning of the segment, interest rates lower for longer. And I always tell my clients the intended consequence that the Federal Reserve would never admit to was kind of hurting people into the stock market.
Yes.
Why, when they keep interest rates this low. So just real quick, do you have an opinion on that?
You hit the nail on the head. And that's where bubbles are created. When fiscal policy or monetary policy is aimed at one thing, rates lower for longer to instill an appetite for risk ends up being taken in another vertical, and that's equities. Equities are primary beneficiary of this low interest rate environment. There's no question people are looking for yield in terms of dividend in equities. They're also looking for price appreciation in equities. There's no question about it. You're spot on, and that has always been a problem. Unintended consequences.
Right. Thank you, Peter.
If I can jump on that with the last 30 seconds, and it's really the savers, right, that are really paying for the recovery.
And
it's
the
people
seniors
that have been fiscally responsible and have money savings in the bank or want to buy fixed income bonds. That lower interest rate that they're earning is really the fuel they're paying for the recovery.
Right.
Spot on. It sounds so incredibly unjust, and it is.
Right. The back of senior citizens. Absolutely.
Yeah.
So let me jump in and remind everybody, it's Kenny's commentary that is available. It's complimentary, and goes to the top desks around the world. And it's free for his comments, and I've been contributing. So everybody should really jump on that and get a little insight for Monday mornings. It's not even every day. It's just once a week. And Peter, you're putting out great information. I'm really honored and happy to be helping you with that and adding whatever I possibly can.
Thanks a million, Jordan. You're absolutely super valuable. Love having your contributions. Extremely valuable. And what an honor it's been to be on with you guys. You guys are such gentlemen and clearly understand markets.
Peter, thank you
Peter.
so much. Again, appreciate the time you spent with us.